All right, let's dive right in, shall we? Today, we're tackling early stage investing.
Oh, exciting stuff.
Yeah, that world where you could be the one backing the next, I don't know, Tesla or Google, something revolutionary.
Absolutely. Being there at the ground floor when a company just takes off, you know?
Right, like imagine, just picture yourself in a room, buzzing with energy,
Ah,
packed with all these innovators, all pitching ideas that could change everything.
it's exhilarating.
Yeah. And our research shows that a lot of these investors, they don't just put all their money in one place, they kind of spread it around,
Yeah. Hmm.
like they diversify.
Portfolio approach, it's super common.
Exactly. Not putting all their eggs in one basket.
Yeah.
But of course, it's not all sunshine and rainbows, right? I mean, high risk, high reward,
Yeah, definitely high stakes involved.
for sure. So maybe you could break it down for us a little, like for someone who's completely new to this, what exactly is early stage investing?
So at its core, it's basically providing capital, money to a company that's in those really early stages.
Okay.
And in exchange for that money, you get equity ownership. You're basically becoming a part owner.
Oh, I see. So it's not like lending money, you're actually buying a piece of the company.
Exactly. You're betting on its potential, hoping it's going to grow and, become the next big thing.
Right, it becomes super valuable. Now, sometimes you hear people call it seed investing or angel investing. Is that all the same thing?
Pretty much. Yeah, different terms, but the same concept.
Yeah.
Fueling innovation and, well, hopefully getting a pretty significant return on your investment down the line.
So it's like you're not just an investor, you're kind of a partner in a way.
Yeah, in a sense.
You're taking on the risk with them.
Exact.
Speaking of risk, that's something all our sources really emphasized, right? This is high risk, high reward territory.
Oh, absolutely.
I mean, we're talking about companies that are sometimes just starting out. They might not even have a product yet.
Right, still in that very nascent stage.
Yeah, so you're really betting on a team, an idea, a market that might not even fully exist yet.
It's the Wild West out there.
It really is. It's like trying to predict, I don't know, the winner of the Kentucky Derby before the horses have even left the gate.
Uh-huh. Yeah, there's definitely an element of that.
But our research does talk about ways to kind of navigate that risk.
Yeah.
One thing that came up a lot was diversification.
Oh, diversification is key. Absolutely crucial.
So, like, how do investors actually go about building a diversified portfolio? What does that look like in practice?
So imagine, right, you have an investor and they're super excited about this one fintech startup, looks very promising,
Okay, yeah.
but they put all their money into it. And, well, what happens if that startup fails? They lose everything.
Oof, yeah, not good.
So instead, what smart investors do is they create a portfolio.
Okay.
They might invest in 10, 20, even more companies across different sectors, different stages of development.
Spreading the risk, so to speak?
Exactly. It's like if one investment doesn't perform well, others might actually flourish and offset those losses.
Makes sense. So it's not about putting all your faith in one single company. It's about having a balanced approach.
Exactly. It's about the long game.
And I guess there are different strategies for diversification, right? Like some investors focus on specific industries or maybe specific stages of a company's growth.
Right. They might have like a set allocation.
Oh, like a percentage?
Yeah, like I'm going to put 30% of my portfolio into seed stage companies, 50% into Series A funding rounds, and the remaining 20% into those later stage companies.
Okay, so there's actually a science to this.
Oh, there's definitely a method to the madness.
Okay, so we talked about spreading the risk, but now how do these early stage investors actually choose which companies to back in the first place? I mean, it can't just be gut feeling, right?
No, there's a lot of research and due diligence
It's
involved.
got to be more than just liking the founder's energy, right?
Uh-huh. Yeah, there's definitely more to it than that.
So our sources mentioned a bunch of different factors like market potential, the competitive landscape, the team's expertise, the product or service itself.
All those are crucial.
But I feel like understanding the market is probably a good place to start, right? Like, how do investors figure out if a startup is actually addressing a real need?
That's fundamental. You can have the coolest idea in the world, but if there's no market for it, it's going nowhere.
Right, it's got to solve a problem that people actually have.
Exactly. So investors, they use different frameworks and tools to analyze the market.
Like what?
Well, one common one is called TAM analysis, which stands for Total Addressable Market.
Okay, TAM analysis, got it.
And this helps them estimate the overall revenue potential, like how much money could this product or service realistically generate.
So, like, if a startup is creating, I don't know, a new platform for online learning, they wouldn't just look at the current size of the online learning market. They'd also try to project how much bigger it could get in the future.
Precisely. They're looking for markets that have room to grow.
Right, because even if a market is huge right now, if it's already dominated by, like, established players, it might be really tough for a new company to break in.
It's like you need a market that's big enough and has space for a newcomer.
So a sizable market and, what was the word?
Room for growth.
Yes, room for growth. Okay, now another thing our sources kept coming back to was the importance of the team.
Oh, the team is everything.
Yeah, like it's not just about the idea, it's about the people who are going to make it happen.
Right, because a great team can take a good idea and make it amazing, but a weak team can, mess up even the most brilliant
I
concept.
could totally fumble it, yeah.
So investors, they look for experience, passion, a proven track record. They want to see a team that can execute, that can adapt, that can handle all the challenges of building a business.
Yeah, because it's never going to be a straight line to success, right?
Oh, definitely. There are always going to be bumps in the road.
You need a team that can handle the pressure.
Resilience is key.
Absolutely. Now, earlier you mentioned that early stage investing is about more than just the money, more than just that initial check.
Right.
And our sources also talk about the role of the investor, like what they bring to the table besides capital.
Yeah, a lot of early stage investors, they see themselves as partners, not just financiers.
Okay, so they're more hands-on.
Yeah, they might offer mentorship, guidance, connect the startup with people in their network, really help them succeed.
That's interesting, but isn't there a risk of being too involved? Like, could an investor's advice, even if it's well-intentioned, end up stifling the founder's creativity or even steering the company in the wrong direction?
Oh, for sure. That's a valid concern.
Like you don't want to micromanage.
Exactly. Finding that right balance is crucial. The best investors, they provide support and advice without taking over.
Right. It's more about empowering the founders, helping them make informed decisions, connecting them with the right resources.
It's about being a strategic advisor, not a dictator.
Exactly. A sounding board, someone who's been there, done that.
Someone who can open doors.
But at the end of the day, every investor wants to see a return on their investment, right?
Of course, that's the goal.
So how do early stage investors actually make money? What are the exit strategies?
Well, the most common one is an IPO, when the company goes public.
Oh, right. Like an initial public offering, their stock gets listed on the stock market.
Exactly. And then there are acquisitions, which is when another company comes along and buys the startup outright.
So the investor gets a payout based on their equity.
Right. Their shares are now worth something, hopefully a lot more than what they initially invested.
Gotcha. Now, what about this secondary market I keep hearing about?
Ah, yes, the secondary market. That's basically a marketplace where investors can buy and sell shares of private companies.
So even before a company goes public or gets acquired, investors can potentially cash out.
Exactly. It provides some liquidity, a way to potentially realize some gains before those big exit events.
So even though early stage investing is definitely a long game, there are still opportunities to see some returns along the way.
Definitely, there are different paths to liquidity.
That's really good to know. Well, as we wrap things up here, is there, I don't know, maybe one final thought you'd like to leave our listeners with, something to chew on?
Well, I think it's important to remember that early stage investing is always evolving.
It's a dynamic landscape, for sure.
With all these new technologies and industries emerging, it's a really exciting time to be involved. So I guess I'd ask our listeners, what sectors, what emerging trends do you think hold the most promise for early stage investment in the years to come?
Ooh, that's a great question. Definitely something to ponder. Well, thank you so much for walking us through all this. It's been incredibly insightful.
My pleasure.
And to all our listeners out there, keep exploring, keep learning, and who knows, maybe one day you'll be the one backing the next game-changing innovation.
It could be you.
Exactly.